You're welcome back. Now, the Bank of Ghana says it cannot guarantee that all the employees of UT Bank and Capital Bank will retain their jobs under the management of GCB Bank. The takeover of the two institutions by GCB on Monday had left many employers and depositors uncertain of their fate. The central bank has assured depositors moving to GCB they can rest assured, but the workers cannot have similar confidence. Meanwhile, a formal probe has been opened into the conduct of directors and managers of UT and Capital Banks. Once this is, well, one thing is assured of all of this, that the myriad of issues surrounding this takeover are far from over, especially since there's another section of clients and now defunct banks who remain to see what their fate will be in the new arrangements. Now, the executive director of Trust Consult, Charles Mensah, has been analyzing what really happened to these banks.
From where I sit as an analyst, if you look at it critically, if you're a microfinance operator, you lend on the back of fixed collateral security, and therefore you either, when you go to any microfinance company that you want money for expansion of your business, you want money to start business, the first thing they ask for of you is that what collateral security do you have? Which is different from when you're managing a mainstream bank, which is a universal bank. They lend, or they ought to lend on the back of cash flow management. And therefore, if you go to a mainstream bank and we're still having a concept of what fixed asset do you have or what collateral security do you have, then that means that they mixed it. Now, your understanding of the future cash flow of a business, the variables or the triggers for the revenue streams for that particular business would inform you on how you can structure the loan. Unlike the collateral, where you know that you don't care on the triggers. If they don't pay, you have a physical asset to sell. That doesn't happen in the purely universal bank environment. And I think that most of the employees that they had grown, they had both. If you look at Capital Bank and UT Bank, they had grown with some of these employees from microfinance to that level. It was going to be difficult for them to let go. Most of the banks were dependent on treasury bills. They mobilized deposits, and some of them were using a large portion of the deposits on treasury bills. Now, in the last 8 months, the treasury bill rate had dropped tremendously from 20%, 21% to almost about 12% this year. Now, if you had opened branches, mobilizing those funds, and we are cashing in on 20%, now it's about 12%. So the operational costs for some of the branches, there's no way you can cover the revenues that are accruing to you now.
But that's just about 6 months now.
Oh, it is, you know, two weeks.
That's significant enough to collapse two banks?
Of course, because you see, banks usually will grant loans based on time. So they would have probably granted some loans to some customers 2 years or 3 years, or maybe let's say 12 months. However, the fixed cost, in other words, the fixed rate that they had fixed for some of these customers of theirs would have been a certain rate, and that will be difficult to match. So because we are not in an environment where we do floating, so that when there's a change in the MPC rate, which is the monetary policy rate, you can quickly adjust both the revenue side and the cost side. We don't have that environment as yet. So anytime there's a change in the policy rate by B of G, then it has an impact across the board, and that's where the difficulty is.
Did you see this coming? I mean, I think I saw this coming last year when UT Bank laid off some workers, but I didn't see that for Capital Bank, especially when they had just received the license from the Bank of Ghana barely 3 to 4 years on. And then just when they were settling in, they have just been taking over.
I think Yes, I mean, I saw it coming. I saw it come both. Because, you see, fortunately, UT Bank is listed on the stock market. Now, when it is that 2015, post 2015, they have not filed their returns to the Ghana Stock Exchange market. It was a good signal. So this morning that I saw Ghana Stock Exchange Council or Ghana Stock Exchange as an institution issuing a press release to that effect. But it was long overdue. They ought to have written letters to insist, to ensure that they are covering up. I'll explain shortly. You see, when you look at banks, it's usually the management of the assets and liabilities, nothing more to that. Now, when there's a gap, then there should be profits to cover up the gap. When it is that your profit is going down and you have more liabilities than your assets, then there's a gap, and the gap has to be funded. So usually would fund your gap with either shareholders' equity or getting another bank to come in and bail you out. And this has been on the drawing board for quite some time, because I know at a point in time they were talking to Home Finance, HFC Bank. They were talking to a couple of other banks. So most of these two banks were equally talking to other people to come in and bail them out or to come in and shore them up. But that was not forthcoming. Now, if it's not forthcoming, then the likelihood is that the headmaster will come in with a big stick, which is the Bank of Ghana. Now, when the headmaster comes in with a big stick, you know, in the look of things, headmaster will decide what to do.